If you're running a business and you haven't optimized legal and tax structure, you could be paying tens of thousands of dollars more in taxes than necessary every single year. The entity structure you choose is one of the highest leveraged financial decisions a business owner makes. Today, we are breaking down the three most common structures: LCC, S-Corp, and C-Corp, and showing you exactly how each one is taxed so that you can make an informed decision. Welcome to taxamerica.co. I'm Cedric, and business entity optimization is one of our specialties. Today's video covers a clear comparison of LCC, S-Corp, and C-Corp tax treatment, the self-employment tax savings of S-Corp election with real numbers when a C-Corp makes sense and when it absolutely doesn't, the administrative requirements and cost of each structure, transition considerations if you're already formed, and our recommended decision framework. This is meaty topic. Let's get into it. What is an LCC? Is and isn't. An LCC, limited liability company, is a state law creation, not a federal tax entity. From a legal standpoint, it provides liability protection, separating your personal assets from business liabilities. From a federal tax standpoint, an LCC by itself has no default tax treatment. It borrows the tax rules of another structure. The single-member LCC is taxed as a sole proprietorship, Schedule C. A multi-member LCC is taxed as a partnership, Form 1065 and K1s. Both can elect to be taxed as an S-Corp or C-Corp. LCC taxed as sole proprietorship, the default. For single-member LCC that haven't made any tax election, all profit flows to your personal return via Schedule C. You pay income tax plus self-employment tax, 15.3% on your entire net profit. Let's run the numbers to make this concrete. Your LCC earns $150,000 in revenue and has $30,000 in expenses. Net profit is $120,000. Self-employment tax $120,000 times 92.35%. Adjusted net times 15.3% equals approximately $16,956 plus federal income tax, that's $120,000 in your bracket. The federal tax bill could easily be $40,000 to $50,000 plus, depending on other income and deductions. LCC tax as partnership. Multi-member LCC file Form 1065, a partnership return. The LCC itself pays no federal tax. Each partner receives a K1 showing their share of income, deductions, and credits which they report on their personal return. Each partner pays self-employment tax on their distributive share of active business income. Partnership taxation is flexible but can be complex, especially with different ownership percentages, special allocations, or guaranteed payments. The LCC tax advantages: pass-through taxation, no double taxation unlike C-Corp, flexibility in profit allocation, partnership LLCs, simplicity, no payroll required for owner compensation by default. The Section 199A deduction, up to 20% of qualified business income is available to LCC owners. Loss deductibility. Business losses flow through to the owner's personal return, subject to basis and at tax limitation. What is an S-Corp election does? An S-Corp is not a separate legal entity. It's a tax election. An LCC or corporation can elect S-Corp tax treatment by filing Form 2553 with the IRS. The magic of S-Corp: it splits your income into two buckets: salary subject to payroll taxes and income tax distributions subject to income tax only, not self-employment tax or payroll taxes. This split is the source of significant tax savings when it's done correctly. The S-Corp savings by the numbers. Let's compare the same $120,000 net profit under sole proprietorship versus S-Corp treatment. Sole proprietorship, full $120,000 subject to SE of tax $16,956, then income tax on top. The S-Corp, you pay yourself a reasonable salary of $65,000, approximate industry benchmark. Payroll taxes on $65,000. Employer plus employee FICA equals 15.3% times $65,000 equals $9,945. Remaining $55,000 is taken as distribution. No FICA. Income tax on the full $120,000 profit, same either way. Net SE/payroll tax savings, $16,956 minus $9,945 equals approximately $7,011. That $7,100 in annual savings is before the Section 199A deduction, before retirement, contribution strategies, and before other S-Corp planning opportunities over 10 years, compounded with smart investing. This structural choice is worth $100,000 plus. This is why entity structure matters. A reasonable salary requirement, non-negotiable. S-Corp owners who perform services must pay themselves a reasonable salary. Before taking distributions, the IRS scrutinizes S-Corp where the owners pay themselves $1 and takes everything as distributions. Reasonable salary is determined by what the market would pay someone during your specific work. For a web developer owner, perhaps $80,000. For a physician owner, perhaps $250,000. Document your salary decision with industry data. Getting this wrong is the #1 S-Corp audit trigger. A pro tip: use salary comparison tools like the Bureau of Labor Statistics, Occupational Outlook, Handbook, Glassdoor, or industry surveys to document your reasonable salary decision. TaxAmerica.co helps S-Corp clients set and document reasonable salary every year. When S-Corp doesn't make sense, net profit under $40,000 to $50,000 payroll administration costs, often $500 to $2,000 a year, may exceed. SE tax savings run the numbers first. You need flexible profit allocation between partners. S-Corps must allocate income pro rata to ownership percentage. No special allocations like partnership allow. You have non-US citizen shareholders. S-Corp cannot have non-resident alien shareholders. You want more than 100 shareholders or multiple classes of stock? S-Corps are limited to 100 shareholders and one class of stock. The election deadline. To have S-Corp status for given tax year, the election must be filed by March 15th of that year or within 75 days of forming the entity. Late elections can sometimes be accepted by the IRS with appropriate explanation. If you miss the deadline, your election takes effect for the next tax year. Plan accordingly and don't miss it. C-Corp taxation. C-Corp is a separate legal entity that pays its own federal income tax at a flat 21% corporate rate. The result of the 2017 Tax Cuts and Jobs Act. Shareholders then pay tax when they receive dividends, typically 15 to 20% qualified dividends rate, or when they sell shares, capital gains. This creates the famous double taxation problem. The corporation pays tax, the shareholders pay tax again on the non-distributors. Despite this, C-Corps are the right structure for specific situations. When C-Corp makes sense, venture capital and startup funding. If you plan to raise venture capital or institutional investment, a C-Corp, specifically a Delaware C-Corp, is almost always required. Investors, especially VCs, prefer C-Corp because of their familiarity, investor protections, preferred stock flexibility, and favorable treatment in potential IPO or acquisition. If startup investment is your roadmap, form a C-Corp from the beginning. C-Corp disadvantages: double taxation, corporate tax plus shareholder dividend tax, no pass-through of losses to shareholders. Losses stay inside the corporation. No Section 199A deduction. This is only for pass-through entities. More complex administration. Separate corporate tax return Form 1120, potential for accumulated earning tax, and more rigorous corporate formality requirements. Tax inefficient for most small businesses where owners take profits regularly. The qualified small business stock opportunity. Let me dwell on the QSBS a bit more because it's extraordinary. Section 1202 requires the company is a domestic C-Corp when the stock is issued active business in qualifying industry, software, biotech, retail, service qualified, finance, hospitality, professional services like law and medicine generally don't. The company has gross assets under $50 million when the stock was issued, and you acquired the stock at original issuance, not from another shareholder. If you're founding a qualifying startup, the C-Corp election may be worth millions in eventual tax-free. The decision framework. Use this framework to guide your entity decision. First question, are you seeking venture capital or planning an IPO? If yes, C-Corp likely Delaware. Second, is your net profit consistently above $50,000? If yes, model S-Corp savings versus administrative costs. Third, do you need flexible profit allocation or have non-US owners? If yes, LLC taxed as partnership. Fourth, do you have high retained earnings as partnership? Do you have high retained earning needs and qualify for QSBS? If yes, C-Corp. For most small businesses, solar service providers, consultants, contractors, LLC with S-Corp election at the right income threshold is the most tax-efficient common choice. Annual review is essential. Your optimal structure today may be optimal in 3 years. As income grows, as you add employees, as you consider outside investment, the right structure evolves. At taxamerica.co, we review business entity structure with every business client annually. Sometimes the recommendation stays the same. Sometimes a simple election change saves $15,000 per year going forward. You won't know unless you review. The comparison summary. LLC, sole prop default. Simplest setup, full SC tax, all profits, best for early stage or low income businesses. LLC with S-Corp elections. Sweet spot for most small businesses earning $50,000 plus net profit. Splits income between salary, FICA, and distributions, no FICA. Annual savings, $5,000 to $20,000 depending on profit level. C-Corp, best for startups seeking investment, QSBS qualification, or high retained earnings. Double taxation on distributions, 21% flat corporate rate required for VC-backed companies. No single structure is universally best. Model your specific numbers before deciding. Review annually. Your optimal structure evolves with your business. The right business structure isn't just a legal formality. It's a financial strategy that pays dividends every single year. At taxamerica.co, we analyze and optimize business entity structures for clients at every stage. If you're not sure whether your current structure is the most tax-efficient option for your income level, let's find out together. Visit taxamerica.co to book your free business tax strategy session. Subscribe for more content like this, and I'll see you on the final video of our series.